Welcome to my dear students. I am Mr. Ganeshan K, Assistant Professor of Commerce, Subject Corporate Accounting, topic Profit Prior to Incorporation. In this session, I am going to solve problem on Profit Prior to Incorporation, that is preparation of profit and loss account and balance sheet as per World Companies Act. The Luck Private Limited was incorporated on 1/7/2012 with an authorized capital of 5 lakh in equity shares of ₹10 each to take over as a going concern as from 1/4/2012 the existing business of Balu Brothers. The agreement for taking over provides that all profits made from 1/4/2012 should belong to the company. The purchase consideration of 2 lakh together with interest at 8.75% per annum was satisfied on 1/10/2012 by the allotment to the vendor 17,500 equity shares fully paid and balance in cash. The trial balance of the company on 31st March 2013 were as follows: share capital 2,28,000, freehold land 25,000, building 65,000, furniture 7,500, salaries 12,000, purchases including stock taken over, that is for 4,85,000. It means including opening stock. Sales including sales prior to incorporation 75,000, 4,50,000, sundry debtors 45,000, sundry creditors 30,000, rent received 6,000, repairs 1,500, directors fees 1,200, miscellaneous expenses 7,200, interest to vendors 8,150, cash in hand 1,800, cash at bank 48,050. Total 7,11,000, 7,11,000. I will analyze this problem. Share capital, balance sheet liability side, freehold land, fixed asset, building, fixed asset, furniture, fixed asset, salaries, that is based on time ratio, then purchases including opening stock, trading account, sales, trading account credit side, debtors, current asset, creditors, current liability, rent received, to be apportioned based on time ratio, rates and taxes, time ratio, repairs, time ratio, directors fees, post incorporation, miscellaneous expenses, time ratio, interest to vendor, revised time ratio, cash in hand, current asset, cash at bank, current asset. Stock on 31st March 2013, 1,40,000. One entry we are supposed to record it in our trading account credit side, and another entry balance sheet asset side. Provision for doubtful debts to be made at 2,500. Depreciate building by 5% and furniture by 10%. Now we are supposed to calculate time ratio pre-incorporation period, that is from 1/4/2012 to 36/2012, that is pre-incorporation period, that the business was acquired on 1/4/2012 and it was incorporated on 1/7/2012, that is 36/2012. Then comes to 3 months post incorporation period, 1/7/2012 to 31st March 2013, 9 months, 3:9, 1:3. Then we are calculating sales ratio, pre-incorporation sales given in the problem 75,000, post incorporation period sales, that is 4,50,000 minus 475,000, 3,25,000. 75,000 is to 3,25,000. We are getting 1:5, which will be our sales ratio. And then we are preparing trading account. Two purchases including opening stock 4,85,000. Then sales given in the problem 4,50,000. Closing stock is 1,40,000. Total 5,90,000. Difference will be the gross profit, which comes to 1,05,000. And then we are preparing profit and loss account for the year ended 31st March 2013. Two salaries as discussed earlier, time ratio, rates and taxes, time ratio, repairs, time ratio, miscellaneous expenses, time ratio. Accordingly, the amounts come to 3,000, 9,000, 750, 2,250, 375, 1,125, miscellaneous expenses, time ratio 1,800, 5,400. All these expenses has been apportioned based on time ratio, that is 1:3. I will show you an example here. See, we are having salaries. So salaries given in the problem. What is salaries here now? 12,000. Okay. This 12,000 has been apportioned on the basis of time ratio, that is 1:3. 12,000 into 1/4. 12,000 into 1/4. We are getting 3,000, 9,000, like that. All these expenses are apportioned based on time ratio. Interest to vendor, revised time ratio 4,375, 4,375. Bad debts given actual 2,200, 300, and then he has given you what reserve for bad and doubtful debts, that is post incorporation, directors fees, post incorporation, depreciation, time ratio 1000, 3000, rent received, time ratio 1500, 4500, and then whatever the profit we get in case of pre-incorporation, that will be transferred to capital reserve, and whatever the profit we get in case of post-incorporation, that will be transferred to profit and loss appropriation account. Now, directly we are transferring it to profit and loss appropriation account, and there is no adjustments in the profit and loss appropriation account, and therefore it will be directly transferred to balance sheet. So we are preparing balance sheet as usual. Share capital 2,25,000, share capital 2,25,000, and then we are having what is that reserves and surplus. So under reserves and surplus, we are having what capital reserve 7,500, then P&L account balance 62,850. Under current liabilities, we come across sundry creditors. Under fixed assets, we are having freehold land 25,000, building 65,000, depreciation at 5%, 3,250, 61,750, furniture 7,500, less depreciation at 10%, 750, 6,750. Current assets, we are having debtors 44,500. From that we are deducting bad debts 2,500, and then we are deducting what RBDD also. So your RBDD given in the problem is what 2,000 what 500. So therefore your bad debts given is your bad debts will be 200, right? So I repeat once again. So bad debts given is what 200. Bad debts given is what 200, and RBDD is what 2,000 what 500. Balance we are getting what I can say what 42,000. Cash at bank 48,050. Cash in hand 1,800. Balance sheet total 3,25,350. 3,25,350. Thank you.